Welcome to our 2026 webinar series, America 250. As we honor our nation's semi-quincentennial, we will focus on securing financial independence for American families, whether it be long-term care, disability, annuities, or life. Insurance is all we do, and we look forward to providing comprehensive knowledge of these valuable financial instruments to assist you in best serving your clients. In today's presentation, we will look at long-term care insurance and the valuable financial protection it can offer. Today's webinar is being recorded and will last about 50 minutes. You must be logged in the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We will answer all questions as best we can. If we do not get to your question today, you will receive a response by email. The webinar will be posted to our website within 24 hours. Today's presenter joined LLIS in 2015 as a specialist in life, disability, long-term care, and hybrid solutions. She's happy to be a resource in assisting advisors and their clients with all aspects of insurance planning. Here to present is Taylor West.
Yeehaw, everyone, and thank you for joining me in the American frontier. If you couldn't tell by my last name, my family hails from the plains of the Wild West. So I thought that this would be a great place for us to meet for an afternoon of insurance education. You might be here for a deep dive of long-term care insurance, but you're going to have to endure a few jokes along our journey. So to get started, what do you call a happy cowboy? A jolly rancher. And what do you call an outlaw who steals cattle? A moocher. Okay, enough of that. Let's saddle up, cowboy up, and get started with long-term care. So first, I want to give you guys some statistics on long-term care, maybe how likely it is. 48% of people turning 65 will need some type of paid long-term care service in their life. 71% of total long-term care spending is covered by public programs, majority of this being state Medicare funding or Medicaid funding. 78% of care is provided in the home. Majority of claims begin in the home, and it's actually the longest duration of claims are provided with in-home care. And 37 million family caregivers in the US are providing unpaid elder care. And this is a really, really big one because it's one of the biggest reasons why clients want to have long-term care insurance, because it allows our loved ones to manage our care rather than be a caregiver. It provides that safety net so that our loved ones know that there's something there that can assist during an already tough time. Let's look at cost of care. We know it's expensive, but how much is various costs of care around the country? Well, as you're going to see here, costs vary not only by location, but also by the type of care that you receive. So here in Tampa, we're a little under $6,500 for home health care. This is based on 44 hours per week of licensed and skilled caregiving. A little over $5,000 a month for assisted living care and over $12,000 a month for a nursing home. New York City, those costs are naturally going to shift up a little bit, almost $7,300 a month for home health care. Assisted living over $9,700 a month, and nursing home care almost $16,500 a month. In Houston, the cost of care is kind of more consolidated with those different types of care. So you have about $5,700 for home health care, up to $8,300 for nursing home. Seattle, it's much more expensive, pushing almost $19,000 a month for nursing home care. And these are private rooms in a nursing home. Los Angeles, ranging from $7,500 a month to over $12,000 a month. And Kansas City, home health care, about $6,900 up to almost $11,000 for nursing home care. So we see that These costs can really rack up over a couple of years of needing care later in life, especially when you're on a fixed income. So, when do we think about buying long term care? This is really a question I get very frequently of what's the right time. Well, there isn't a perfect answer, but a few things to keep in mind is not only is our own health taken into account with long term care underwriting, but so is our family history. So as we age, so do our parents. And family history is considered. So that family history is mainly going to consist of cognitive impairments like Alzheimer's or dementia. And if we have both parents diagnosed with a cognitive impairment, it can be difficult to obtain coverage, even if we are in perfect health. Once you hit 65, we're going to be going through those Medicare health screenings, and naturally, things come up when you get testing done. So there can be some diagnoses or health conditions that are discovered during these screenings, making clients uninsurable. You can also apply early to ensure that you're not only locking in your insurability, your medical insurability, but also while premiums are low. We do mention locking in premiums here, but we know traditional long term care premiums are not guaranteed. We'll talk about that a little bit later in the presentation, but we are at least starting at a much lower rate the earlier that we apply. And when I keep referencing eligibility, I do that because long term care underwriting is very stringent. So declines are very common. 49 and below, that's usually the youngest side of long term care planning that we see. And there's still a decline rate of about 12%. That naturally increases the older that clients get. And by the time clients are in their early 70s, we're looking at almost a 50% decline rate. So if you think of this in reference to your married couples that are planning for long term care, thinking about securing coverage, one of those two individuals are, statistically speaking, likely to be declined in the underwriting process if they wait until their 70s. That's not even taking into account the premiums at that age, but the decline rate can get pretty high. So it's important to start thinking about this early. And the reason why I say all this is because long term care doesn't have several rate classes like we see with life insurance, for example. Life insurance, there can be 12 different rate classes that a client might fall into. If the insurance company sees a heightened risk, they just increase the premium. But with long term care, it is mostly an approval or a decline system. There are situations in which the insurance company might increase the premium or reduce the maximum monthly benefit that they qualify for. But in, I would say, 85 to 90% of cases, we're either getting an approval or a decline. And some of the common obstacles that I see during the underwriting process, especially for clients that are at the age to be thinking about long term care, is arthritis. This is really tough because a lot of clients, as they get older, have osteopenia or osteoporosis, arthritis, and they might go to physical therapy for these sort of conditions. Physical therapy is an automatic non starter with long term care companies. If clients are currently in physical therapy, they will not consider, and they're going to need a full 6 months after completing physical therapy to even consider offering coverage to a client. The main thing that the insurance companies want to see is stability. So if there is a reason that clients are going to physical therapy, whether it be limitations in day to day activities, pain, they don't want to consider clients like that until it's stable, because if we think why clients need assistance or long term care in the future, it's due to those limitations of activities of daily living, in addition to cognitive impairments. Changes in medications, very common. Once again, they want to see stability. So if clients are on new medications, they might want 6 months to see how the clients are reacting to that medication and if it is controlling symptoms and stability. Injections, steroid injections, that can be tough if they are recurring. And significant comorbidity. This is when it can get a bit difficult or more difficult because certain conditions on their own might not seem all that concerning. But when clients have comorbidity and there are several things, several medications they might be taking for different conditions, that becomes a concern for long-term care companies. Traditional long-term care insurance companies are going to be looking at those medical conditions that impact ADLs, like I said. So ADLs are the main six are eating, bathing, dressing, toileting, continence, or transferring. These six activities of daily living are what trigger benefits to be used in the future. So they're going to really be looking at ADLs. For hybrid life long term care policies, underwriters are going to look at ADL conditions that might be impacted or medical conditions that affect mortality. There is that life insurance component of these policies. So they might care more about cancer history than traditional long term care companies might. Hybrid annuity long term care policies are going to be the most lenient when it comes to underwriting. They do a lot of simplified underwriting for one specific annuity. They think they ask 8 questions. And if you answer no to those 8 questions, you're approved. Sometimes it can be that simple with hybrid annuities. So let's talk about the features of long-term care policies. And this is across the board. This goes for the different types of long-term care options we have that I just mentioned, traditional hybrids. They are all going to have a monthly benefit. That monthly benefit is what they can receive when they are on claim to assist with long-term care expenses. When clients or advisors come to us and they don't necessarily have a monthly or daily benefit in mind as a starting point, what we do is we look at the cost of care in their area. And if we think back to that first slide of 78% of claims starting in the home, ideally we have a monthly benefit that covers 100% of home health care costs in their area. Oftentimes, that translates to 50 to 70% of nursing home costs. So it will cover less of the nursing home costs, but ideally, they are going to be in a nursing home or facility for a much shorter period of time than they would at home. All policies will have an elimination period. This is basically a waiting period. So once a client meets one of the two triggers to receive benefits, it's the same across the board as well, the inability to complete two activities of daily living, or a severe cognitive impairment that requires supervision. Once they meet one of those two triggers, a clock basically starts. And the most common elimination period we see is 90 days. So after 90 days has been satisfied or met, the insurance company then starts to pay those claims. There is also a benefit period. How long is the insurance company going to pay you that monthly benefit if you are on claim? Then we have inflation protection. Most often, we see a 3% compound inflation rider. And regardless of the percentage, it's very important to have an inflation rider on a long term care policy. We saw how high those median cost of care um, is in different parts of the country, and that only continues to grow over time. So, if we think of a 55-year-old today securing coverage, if they have a $5,000 monthly benefit, that might not go very far in 30 or 40 years when they go on claim. So it's important to have an inflation rider to ensure that those benefits continue to grow with the rising cost of care. Then there is a shared care rider. This is common on traditional long term care policies, and we pretty much always recommend that married couples that are applying together have a shared care rider. Because what this rider does is it provides additional flexibility at claim. Both spouses have their own benefits for them to use as needed. But if one spouse maybe needs more than they have allotted individually, they can tap into their partner's pool of benefits. Or with one company, they actually spin off a third pool of benefits. So rather than depleting your spouse's benefits as well, you deplete this shared pool and leave your other spouses intact. So the shared care rider is really great to have for joint policies. There's a few ways that benefits are paid out. Reimbursement is the most common. Reimbursement means that when you are on claim, you submit your care expenses to the insurance company each month, and then they reimburse you up to your maximum monthly benefit for qualified expenses. And what qualified expenses means is care that's provided by a licensed and skilled caregiver, a legitimate home healthcare organization that's licensed, insured, and skilled, or a facility. This means that you cannot pay or compensate a loved one to help out around the house. And that can take a really big toll for loved ones to be providing a lot of care. Maybe they're taking time off work, able to work less hours, paying out of pocket for some things that are needed for their elderly parent who is at home needing care. So that reimbursement does pay benefits. However, you have to submit those expenses and they're only for qualified care. Then there is indemnity. Indemnity benefits are very common with hybrid policies, and they are the most flexible. They're cash benefits. So rather than having to submit your expenses to the insurance company each month, the insurance company just writes you a check for your monthly benefit. And you can do with those benefits what you would like. Most often, that is used, as I said, for paying or compensating a loved one, for providing care and spending time at the house and assisting. It can also be used for other things like paying a mortgage if there's still a mortgage at that time, maybe hiring a lawn service, a grocery service, different aspects of our life that wouldn't necessarily be compensated by reimbursement benefits. And then, of course, there is the premium. We'll see variations in premiums throughout this presentation, but I spoke a little bit about the starting point of a monthly benefit. We always look at 100% of home health care as a general rule of thumb. But with the benefit period, we look at the stats of genders and how long they're on claim. Men are on claim an average of 2.2 years. Women are on claim an average of 3.7 years. So when we're looking at single clients, for single men, I start with a 3-year benefit period. And for single women, I start with a 4-year benefit period. For married couples, we tend to start with a 3-year benefit period with the shared care rider. Since it does add that extra layer of flexibility and protection later on, that 3-year benefit period can actually equal 9 years with one company because that shared pool that they provide. And speaking of premiums, many of your clients have received dreaded letters in the mail of premium increases on their old long-term care policies. I have one in my inbox right now ready for me to review that an advisor sent over. So let's talk about why these insurance companies had to issue premium increases. It's broken down into 3 factors here: lapse rates, interest rates, and underwriting. Let's talk about lapse rates. In the 80s and 90s, when long-term care first entered the market, it was a super hot product. People really wanted it, and they wanted it because it is really important and it provides a safety net that had not been provided in the past, and that really nothing else out there does for this specific type of care. So, what insurance companies do is they have a general guess of how many policies they're going to have in the future. So, we kind of oversimplified this. These long term care companies estimated a 4% lapse rate. That was their assumption. So, if the insurance company needs $1,000 per year to pay benefits in the future, they can charge everyone $665 since only 66,500 policies will be in place in 10 years when they might need to start paying claims. Well, This was the first mistake of these original companies that were in this space because they were using data from life insurance. And these are two completely different types of insurance. So rather than a 4% lapse rate, everyone kept their policies pretty much. It was actually closer to a 1% lapse rate. So rather than gathering, $904 a year per client, they were gathering 665. So they were already upside down right off the bat with hundreds of thousands of policies. Interest rates. What insurance companies do is they collect premium payments from clients. Then they invest those premiums in order to pay out claims in the future. So a lot of the premium calculation determining how much to collect from clients is based on these interest rates. And unfortunately, at the time, interest rates were high, but not long after they were pricing these policies, interest rates fell and they stayed low. So these insurance companies did not earn the interest that they anticipated on the premiums collected. So they didn't collect enough and they didn't earn enough on what they collected. Two for two here. And then they really missed the mark with underwriting. Once again, they were using guidelines from life insurance. And life insurance pays a claim in one scenario, and that is death. They are worried about you dying too soon. Long-term care companies are worried about you living too long and all of the complications that come with an extended life expectancy. So, as I started off this presentation by saying that LTC underwriting is quite stringent, back then it was not. They were offering unlimited benefit periods to clients with severe chronic conditions that should not have qualified and wouldn't qualify today. Today, some of those clients would be postponed. They might need to see a period of stability that they were not requiring back then. Maybe they would have a slightly higher premium today to account for that additional risk, a limited benefit period, or most likely declined coverage altogether. So the combination of those things really put the industry behind right off the bat, and it's been hard to dig themselves out from that. Now, a lot of these companies that are no longer in the market, they are still very successful insurance companies and they have the ability to pay claims. But they also are needing clients to pay more for the benefits that they have because they simply did not price them accurately up front. There is good news that comes out of this, and I've talked about this before that, policies are priced with more claims experience. We have a lot more data. They are using much more conservative and lower interest rate assumptions, as well as understanding lapse rates that they have experience with, and they are underwriting much more strictly. Society of Actuaries did a study a couple of years ago saying that the chance of long-term care insurance premiums for policies that are issued from 2022 on have less than a 10% chance of, or likelihood, I should say, of being increased in the future. And if there is a need to increase those premiums, Society of Actuaries says that that increase would likely be 10% or less. So once again, we're not guaranteed, we're not out of the woods with traditional long-term care premiums being locked in truly, but things look a lot brighter and it's a lot less likely to see increases like we have recently. So this is a couple that just came to me within the last couple weeks with a rate increase. When they first secured their policy, they had a $250 daily benefit. Because of their inflation rider, that's now up to $417. 90-day elimination period, a 4-year benefit period with shared care, 5% compound inflation rider, which isn't all that common these days. As I mentioned, we usually see about a 3% inflation rider because 5% is very expensive. And they started with right under $7,000 annual premium. And this is a combined annual premium covering both of them. Their increase letter told them that that is going up to $12,000 a year to keep that same coverage. The first thing I do when I get an email like this and I start to review their coverage, I look to see what that same coverage would cost today. So, though we're looking at a $12,000 annual premium, that same coverage would cost them close to $34,000 today. So sometimes that reference point can really be all that clients need. But what do we do? If the clients are able and willing to pay the increase in premium, ideally we simply accept the increase and keep the coverage as is. But oftentimes these increases are even higher than what we just saw, and the premiums are increasing a couple of 100%. So that might not be accessible for the client to still pay the premiums. So the first thing that I recommend is to reduce the inflation percentage. These clients have a 5% inflation rider, so maybe we look to reduce that to 3 or to 1%. I recommend this for most ages anyway, unless we have, some other benefits to work with. But as clients age, if they are in their late 70s, and we can look to reduce that inflation, it's already done most of the work. And so, because they are later in the policy years, they might not need as much growth as they did when they secured this policy 20 years ago. So, that's the first thing we look at. The second thing is to reduce the benefit period. If clients have a 6 or a 7 year benefit period, that's great because we have some wiggle room and some benefits to work with by maybe reducing that to 4 years or 5 years. So for these particular clients, I still recommended changing that inflation percentage. Only 1% was available for them, but it saved them almost $4,000 a year. So we were able to get almost back to that original premium, still having some sort of inflation rider to grow that benefit over the next 10, 20 years until they need care. Something else that I really like about reducing the inflation percentage is, along with unlimited benefit periods, 5% inflation riders are actually the first series of policies that you're going to see have a rate increase. Because those benefits are growing so quickly and that rider is so expensive today, they are using these rate increase letters to kind of go for the highest inflation percentages and the longest benefit periods. So not only does reducing the inflation percentage here help with the premium, but it also can help with future rate increases as well. So we went over the not so great rate increases we see. So I think it's time that we pull over and we get another joke in. What do you call a horse that lives next door? A neighbor. Okay, that's enough of that. Let's go into traditional long-term care insurance and talk about some case design here. So we are going to meet a couple that lives in San Antonio, Texas. The median cost of care in San Antonio, little under $5,900 a month for home health care, assisted living, $6,000 a month, and nursing home, about $8,500 a month. So based on that rule of thumb I mentioned earlier, I started with a $6,000 monthly benefit to ensure that we can cover 100% of those home health care costs. And that equates to 71% of those higher nursing home costs as well. So this is pretty good. So let's take a look at Fred and Alice. They are 55. We kept that 6K monthly benefit, a 90-day elimination period, a 3-year benefit period with shared care, and a 3% compound inflation rider. The quoted combined annual premium for them is $6,760 a year. But I also wanted to show what changing the benefit period or the elimination period would do to the premium. So obviously, the longer the benefit period, the higher the premium is going to get. But if we look to maybe push out that elimination period to 180 days, which is really the maximum that I would recommend, If you think about a 2.2-year claim, you don't want to spend a year of that waiting for benefits. So 180 days is the maximum I would recommend, but it can help clients maybe that are older secure some coverage by pushing that elimination period out a bit. So just by keeping a 3-year benefit period and everything else the same, 180-day elimination period saves $700 a year. So as you can imagine, this can be the breaking point of something being accessible for clients or not. Let's also look at the different costs at ages. So at 55, like we said, $6,760 a year. If they secured coverage at age 50 for these same benefits, that would have saved them about $1,000 a year. Alternatively, it would cost an extra $1,000 if they waited to age 60. And by 65, we're at pushing $10,000 a year for an annual premium. So as you can see, that 50 to 55 age range that I gave as a general timeline to start talking to your financial advisor around 50, start getting an idea with your spouse, a plan with your children to understand what you would do in the event of needing long-term care. And having something in place by 55, you can lock in those premiums at a lower rate rather than waiting into your 60s when those really start to balloon. Underwriting is difficult, so sometimes it doesn't turn out like we expect. So if only Fred qualified for coverage, the same benefits would cost him $2,600 a year. And for Alice, $4,300 a year. You can even see that difference in male and female pricing. Because we live much longer, we are much more likely to use benefits. Coverage costs a lot more for women. So let's look at another underwriting outcome that just happened this week. For a same-sex couple, we have two men, Ron and Sal, 56 and 60. They applied for a $9,000 monthly benefit, 90-day elimination period, a 2-year benefit period with a shared care rider, 5% compound inflation, with a quoted annual premium of right under $12,000 a year. But underwriters did their full review of medical records in an interview, and Ron was approved for a maximum monthly benefit of $5,000. So what do we do in this scenario? Well, there's really two options here. Option one, and I will start out by saying, in order to have the shared care rider, both spouses have to apply for the exact same benefits. So they have to have the same benefits on the book. So with option one, to keep the shared care rider, both spouses would have a $5,000 monthly benefit, all other coverage the same, and we would be looking at a $7,469 annual premium. Option two, keep that $5,000 for Ron, since that's the maximum he's eligible for. Keep $9,000 for Sal, which is what they originally wanted, but that would not allow them to have the shared care rider. So that would cost $8,744 annual premium. So now let's talk a little bit about hybrid life. These are great. They are a lot more common these days, and they provide a good option for clients that we didn't necessarily have before. These policies are very similar to traditional long-term care policies. They have a monthly benefit that you can choose. So we can still base it off cost of care in a client's area. They can choose their benefit period. Anywhere from 2 years to even a lifetime benefit period is still available. Inflation protection, this tends to be 3 or 5% compound, and it has a small death benefit. The death benefit of these policies is determined by the monthly long-term care benefit. So you cannot choose a death benefit and a monthly long-term care benefit. Those are one and the same, and they're determined by the monthly benefit. These policies are also designed to be funded over a short period of time. So think single premium. a 10-year premium or maybe a 20-year premium. There are level premium options for these policies, but clients will naturally pay a lot more, significantly more than they would if they chose a limited premium schedule. So just as this picture is guaranteed to either make you laugh, confused, I felt both of those things. Just like this picture, though, hybrids have a lot of guarantees, and guarantees are truly the advantages of these. So they have guaranteed premiums. We talked about traditional not having guaranteed premiums; those can increase. Hybrids will not. So even with those level premiums that I mentioned, paying to age 100 or to age 95, they will never increase. They are guaranteed. Arguably, the main advantage to these policies is guaranteed benefits. Clients will have some sort of return on the premiums that they pay in, whether it be with long term care benefits or with a death benefit. So, if clients don't use long term care, if they don't have a long term care event, their beneficiaries will receive a tax free death benefit. This is different than traditional, where it's a use it or lose it type of policy. It's like other types of insurance. It only pays out if you have to use it. And many hybrids have those indemnity cash benefits that we talked about being very flexible at claim. So let's look at individual hybrid life long-term care policies. We are going to look at a $6,000 monthly benefit, 4-year benefit period. Funny enough, with hybrids, 4 years is usually more cost effective than a 3-year. So I'm using a 4-year for these examples for that reason. 3% compound inflation rider, indemnity cash benefits. And because we're looking at a $6,000 monthly benefit, that comes with a $144,000 death benefit. So let's look at a male 49. For a single premium, it would be $71,724, one-time premium. Then the policy is paid up. Inflation rider is still doing its thing over the next 30, 40 years until he needs benefits, but no other premiums are needed. With the 5 pay, $15,560 that he would pay for 5 years, then it's paid up. $8,545 for a 10 pay. $5,671 for a 20 pay, or $4,373 for a lifetime or level annual premium. A female, as I mentioned before, these premiums are going to be a little bit higher just because she's a female. $80,435 single premium, $17,420 for a 5-year premium, $9,546 for a 10 pay, $6,300 for 20, and a little over $5,500 for a level pay. Let's look at a joint hybrid life. This is going to be exactly like the individual policies that we looked at. The main difference with a joint hybrid is that the death benefit, it is higher, but the death benefit functions like a survivorship policy. So the death benefit is payable upon the second insured's death if no LTC is used. So when clients are deciding between two individual hybrids or a joint hybrid, the joint hybrid is a little bit more cost effective. You do save by doing a joint, but you only have that one death benefit that it might not be all that likely to pay out since both insureds have to pass without needing any long-term care. But let's check out these costs. $132,608 single premium, $28,289 5-year premium, $15,878 10 pay, $10,218 20 pay, or a little under $8,000 annual level pay. Sometimes these policies are not accessible for clients, obviously for the premium cost, but when I find that they are a great fit, especially for older clients, is when we have clients come to us with existing cash value. So maybe clients have a permanent life insurance policy that has accrued cash value over the year. Um, and we can use that by doing a 1035 exchange, avoiding a taxable event on the gains in their existing policy, and using it to fund a hybrid long term care policy. Um, and they've basically been paying in premiums for the last 30 years and can now use those premiums to secure coverage and a safety net for the next part of their life, planning for the next phase. So this client, male 65, he had hefty cash value of $183,000. So we looked at one single premium of $183,465. That funded over $10,000 of a monthly benefit, a 6-year benefit period, a 3% compound inflation rider, indemnity benefits, oops, and almost $245,000 of a death benefit. So that is really great coverage for him not having to pay anything out of pocket other than the premiums he already paid in for a life insurance policy. His wife also had a policy. She's a couple years younger, a little bit lower of a cash value, still quite a bit, of $161,000. For her, that funded $8,117 monthly benefit, a 6-year benefit period, 3% compound inflation rider, indemnity benefits, and almost $195,000 death benefit. This is a client that just had her policy issued. She is older at 70 and had much less cash value than those examples that I just showed. So I wanted to also, show her case study here and what a not as hefty of a policy looks like in scenarios like this. So for her, with one single premium, we were able to secure 31,000 or $3,161 monthly benefit, 4-year benefit period, 3% compound inflation rider, indemnity benefits, and $75,870 death benefit. So that's pretty good for a 70-year-old not having to pay anything further from her policy or premium wise. In her existing policy, she was still required to pay about a $12,000 annual premium. So not only did we secure long term care coverage for her, but she no longer is paying very significant annual premiums for a life insurance policy that isn't necessary at this point in her life. So we're on the final frontier here of hybrid annuities. Hybrid annuities are similar to hybrid life policies in that they ride on a specific chassis. So this is a fixed deferred annuity with a long-term care rider. There are not a lot of customizable options here with hybrid annuities like there are with life policies, but it has a long-term care pool benefit period of 96 months or 102 months for joint policies. There is a new policy out there that I believe is 108 months, but this does depend on the client's ages at time of policy issue. They have minimal underwriting, which I mentioned earlier in this presentation, which makes it a great option for some clients. They are funded only by a single premium, and you can add a spouse to an annuity. This is especially important when we think of doing a 1035 exchange. In the previous examples, if we looked at the male who had $183,000 of cash value, we were only able to do a 1035 exchange into an individual hybrid life policy for him due to the 1035 exchange laws that say you cannot take the cash value of an insurance policy that insures one individual and transfer it to another policy that covers more than just that individual. Once again, the advantages of 1035 exchanges are avoiding a taxable event. So we're not able to necessarily do that by insuring another person. But with a hybrid annuity, we can. There's a workaround, and this is the only workaround that we have. And by adding a spouse as an eligible person to a hybrid annuity, they, for all intents and purposes, are a joint annuitant or a joint owner of this policy. But technically, they are not. They are an eligible person for long term care benefits. They can receive all of the long term care benefits of the policy if that's how life shakes out for a particular couple. But if the main annuitant passes away, the policy simply passes to the surviving spouse very seamlessly. If both spouses pass away with no long term care benefits being used, the annuity value passes on to beneficiaries. So you still have that guaranteed payout or return on premiums paid in. But unfortunately, these are funded by non qualified dollars only. There are qualified options. We get that question a lot of clients that might want to take money out of their IRA. We don't necessarily recommend that anyway. We are not tax professionals, but we don't suggest taking money out of retirement to fund a policy like this. So they really are much better with non qualified dollars to avoid any taxability at claim. There are inflation riders that you can add on to these policies. We tend to recommend letting it ride with the guaranteed rates that are already built into the annuity, which are usually around 3%, depending on client's age, state, etc. For this example, we're still going to look at a $6,000 monthly benefit. This joint annuity has a 102-month benefit period, and it requires a $177,000 single premium to fund that $6,000 monthly benefit. So let's look at some of these values. We put in 177,000 and the account value is already higher than that. The account value is the annuity value. But if we look all the way over to the right, that's where our monthly benefit is. That does grow over time, as I mentioned, based on those guaranteed and also projected rates that are built into the annuity. So by year 6, they already have $600 more in their monthly benefit that can be used for either spouse. So let's talk about some rules of thumb here. Generally speaking, and these are very general, but it can be helpful for many. If we think of $5,000 or less in assets, the clients probably cannot afford long-term care insurance premiums. If they have between $2 and $3 million in assets, hybrids might be the best fit. And over $3 million in assets, they can probably self-insure. What I have found is that many clients that technically can self insure still like the idea of having some sort of safety net in place so that their children and them and their spouse know that there is a specific pool of benefits there for a long term care event. Long term care insurance is not designed to cover 100% of every cost, but it's there to protect assets in the event of a claim by helping out with a lot of those expenses. Like we said, maybe that's 70% of nursing home cost, but 30% of that is likely going to be normal day-to-day cost of living that they would have if they weren't on claim. So having something in place not only provides peace of mind to the clients, but also to their children as well. But let's talk about hybrid specifically, and I mean hybrid lives here. Hybrid life policies, I personally think, are a really great fit, especially for younger, healthier clients. Think maybe 45 years old that are high income earners and that are able to pay a limited premium for say 20 years. The policy is then paid up by the time they retire. They are no longer paying any ongoing premiums during retirement. The policy is there for them when they need it. And when you secure a hybrid policy at say 45, it also does add as a permanent life insurance policy for those income earning years that is there for them if they have an untimely death. So that is when it's a really great option and clients are able to afford those limited premiums. Also, as I mentioned earlier, a 1035 exchange. For older clients that do medically qualify, hybrids are a really great fit for those that have existing cash value and have now pivoted their planning from life insurance to long-term care planning. And for those clients that want a guaranteed return. There are clients that don't want to spend thousands of dollars a year on a traditional policy and not know if they need it. It's one of those funny things that when we have homeowners insurance, we definitely don't hope that our house catches on fire, but we sure hate writing those premium payments all the time. We don't want to have to use it, but sometimes you want to get something for your money, and long-term care is one of those conflicting ideals too. So, clients that want to know they'll get something back based on those premium payments, hybrids can be a good fit. What about hybrid annuities? When does it make sense? If clients have an existing annuity that they now, once again, are focused on long term care planning or want a better option than what they currently have. Or for clients that have an existing annuity or cash value life insurance policy and they want to be able to cover themselves and their spouse for long term care. Or for clients that have health concerns and they do not qualify for any other long term care solutions. A hybrid annuity might be the only fit for them at that time. So here is a very simplified overview of traditional, hybrid life, and hybrid annuities. Does traditional have a death benefit? No. But the hybrids do have some sort of benefit paid upon death. Return of premium? No for traditional, but yes on those hybrids. Premium payments, generally speaking, are lifetime for traditional and generally short pay for hybrid life. That hybrid annuity is a single premium only. We're not going to have guaranteed premiums with traditional. And we will have reimbursement style benefits for traditional in the hybrid annuity. But many hybrid life policies, most have indemnity benefits. We've talked about the underwriting. And then, very quickly, since we're running short on time, partnership is only offered with traditional long-term care. It is not offered with hybrid policies because on paper, a hybrid life policy is a life insurance contract and a hybrid annuity is an annuity contract. But what partnership does is it allows clients to keep assets in place and still qualify for Medicaid if they've used their own private long-term care policy. It's basically a way for these states to incentivize clients to secure their own policies. So if a client has a policy that paid out $300,000 of long-term care benefits, but they're still alive and still need care, a partnership qualification means that the state will allow that client to have $300,000 in assets and qualify for Medicaid. So it is another added layer of an advantage that is built in with most states for traditional long-term care. So thank you for attending Long-Term Care in the Wild West. I do want to wrap this up with another joke. What do you call a sleeping bull? A bulldozer. um, let's see. We have a couple of things coming up. More free monthly webinars this year. Next month, June, August, September, October, and November. Some of my team members will be presenting on different topics, so be sure to stay tuned and sign up for those. If you are a part of any fee-only planning associations like NAPFA, Garrett, XYPN, ACP, or NAPFA, please stop by and see Jerry and myself. We will be at all these conferences and we love to see you guys in person. And in case you did not get the email, Academy is coming back. We took a couple years off as a hiatus, but LLIS Insurance Academy is coming back. All the things that you know and love about our academy will be the same. We will be at Clearwater Beach having happy hours, lunches, games on the beach, great networking, great presentations. Um, and it's a really fun time for everyone to get together and talk about our favorite topics, which are various types of insurance. So I know that we have some questions and I'm really pushing the time here. Let me do a very quick scroll through these questions. And if I do not answer them, I'll shoot you an email tomorrow and answer those for you. Let's see, is there medical underwriting in the hybrid life with a 1035 exchange? Yes, the underwriting is going to be exactly the same, whether we are looking at a 1035 exchange or not. Um, Death benefit being given up in the 1035 exchange examples. I would be happy to send those to you. I don't have them in this presentation or off the top of my head, but I would be happy to send those over to you by email. Sometimes you'd be surprised. It might be a quarter of the previous death benefit, and it might be up to a half of the previous death benefit. But usually there is a cut in the death benefit, and that's okay with clients just because we're more focused on a different type of planning at this phase of their life. Does the death benefit on a hybrid policy grow by the inflation amount? Great question. Unfortunately, it does not. The death benefit in a lot of these policies, a lot of this depends on the client's age at the policy issue, but there might be a period of 10 to 15 years where the death benefit is higher, but it does go back down to the initial death benefit at policy issue. To add on to this, there is a larger death benefit that's paid if no long-term care benefits are used. But a lot of these hybrids have a guaranteed death benefit that's usually about 10%. So even if clients use $1 million of long-term care benefits, their beneficiaries still might receive a $20,000 death benefit upon their death. Let's see. Okay, here's another great question. Will reducing the inflation rider jeopardize partnership eligibility in some states? The answer is yes, with an asterisk. So, the main requirement of partnership eligibility is an automatic inflation rider of some kind. If, and that's usually at 3%, but it depends on the state and mainly the client's age. So if a client secured a policy at 55, the requirement would likely be that they have a 3% automatic compound inflation rider to qualify for partnership. But usually once clients hit 70, the requirement either drops to 1% or 0%, depending on what age they are. So oftentimes reducing that inflation rider by the time clients are getting rate increase letters, it will not affect their partnership eligibility. Okay, and that looks like most of them. Some of these other ones are longer, so I don't want to push you guys over your time. I will reach out by email to those of you whose questions I did not get. But I really want to thank you guys for joining me today. I couldn't hear anybody, but you were a great audience, and I really appreciate you guys tuning in. Thank you so much. Bye-bye.